Hello, and welcome to Finance Decoded. All of us save our money in banks, and these banks pay us interest on our savings. They give us more money.
So, have you ever wondered how these banks earn money?
In today's video, let's understand the business model of banks. Think about it. What do banks do with your money?
It can't be that banks take your money.
Keep it in a gigantic locker, lock it safely, and store the keys somewhere secure.
With your money just sitting there untouched. That's how it's shown in films. But that's not how it works in reality. Banks use your money to give loans to others.
And the interest they charge on those loans is their income. Let's understand this with a simple example. This is a bank.
There's only one customer in this bank, and that's you. You deposit $1,000 in the bank.
And this bank pays you 5% interest per year. That's the current rate on your savings account. Your $1,000 is now with the bank.
The bank then gives out this $1,000
to another person. Let's say someone who needs to buy a house. The bank charges 10% interest from the borrower. So the $1,000 from the bank goes to that person. When the borrower repays the bank $100,
the bank will pay you $1,050, and the bank earns a profit of $50. Basically,
this is how the banking system works. But this raises an important question. What happens when the bank has already given your $1,000 as a loan to someone, and the due date for repayment hasn't arrived yet, but you urgently need to withdraw your money?
The bank doesn't have your $1,000 anymore because it's lent out.
Or worse, the borrower can't repay the loan. Your money is gone! These situations are very problematic for banks. Of course, no bank has just one depositor and one borrower. There are millions of both. Even so, banks don't keep most of their deposits in cash.
They lend out the majority to others. That's why the Federal Reserve, Fed, the central bank of the United States, has rules in place. Of all the money deposited with a bank,
it must keep 3% to 10% of it as a cash reserve.
This is known as the Cash Reserve Ratio, CRR. And since the Federal Reserve is the boss of all banks, it decides what the CRR should be. This rate changes over time.
Some time ago, it was around 3.5%, and presently it's about 4%. Apart from this, there's another ratio, the Liquidity Coverage Ratio, LCR. This ratio is around 18% for large US banks today. This means that the Fed requires banks to keep at least this percentage of their deposits in safe assets, such as US government bonds, gold reserves, or securities. So for US banks today, if you exclude the combined 22%, 18% plus 4%, the remaining 78% of deposits can be used to issue loans and earn profits, primarily from the difference in interest rates. You might say, that's a lot. If banks are lending out 70-80% of our deposits, what happens if everyone tries to withdraw at once?
That's called a bank run. If all the depositors of a bank try to withdraw their money at the same time, the bank will collapse.
Because no bank in the world holds all the deposited cash physically. It's not a realistic concern, unless panic spreads because of some bad news. But what does happen is that banks sometimes lend out huge amounts, and some loans turn bad, meaning the borrowers can't repay. This leaves the bank short of funds to pay depositors. That's what happened with Washington Mutual Bank in 2008, and later with Silicon Valley Bank in March 2023. Although the situation is now under control, the government intervenes in such cases to stabilize things. Often, during crises, there's a limit on how much money you can withdraw per month. That's what happened to the customers of those banks too. Anyway,
coming back to our topic. This interest rate difference is a major source of income for banks. It's the difference between what banks pay on deposits and what they earn on loans. But what about countries where the interest rate on loans is very low? Like Germany. There, the interest rate on housing loans is around 1%, and in some cases as low as 0.4%, even 0.5%. So how can banks make money when their lending rates are that low?
In those Western European countries, banks reduce the interest rates on savings accounts. In most cases, they pay 0.1% or even 0%. Sometimes, they even charge customers monthly fees for maintaining bank accounts. So if you want to use the bank and keep your money there, you actually pay the bank to do so. It may sound unrealistic, but this is already happening in many European countries. Now let's talk about other sources of a bank's income. There are two main additional sources:
fees and commissions. Banks charge for services like maintaining minimum balances,
ATM use, wire transfers, etc. These aren't the main income source, but do contribute. Investments. Banks invest in government bonds, gold, or the stock market. The returns they earn from these investments are also a major source of income. If we talk about expenses, a major portion, about 30%, 40%, goes toward employee salaries and management costs. Let's look at some real examples. We'll take two major US banks, the largest,
JPMorgan Chase, and the biggest consumer-focused bank,
Bank of America. According to data from December 2021,
JPMorgan Chase was valued at $470 billion,
while Bank of America was around $360 billion. In terms of deposits, JPMorgan holds 15.6% of all US deposits, and Bank of America holds 11.3%. Of all loans issued, JPMorgan provides 12.4%,
while Bank of America accounts for 10.8%. As of March 2021, JPMorgan had 70 million customers, and Bank of America had 67 million. Even though JPMorgan's market share is slightly higher, its valuation is significantly greater, reflecting higher profitability and investor confidence. The reason behind it is the difference in ownership and objectives among banks. In some countries, such as India, you have government-owned banks that must follow national and social priorities. But in the United States, both JPMorgan Chase and Bank of America are private banks. However, their business focus differs.
JPMorgan Chase leans more toward investment banking and global financial services,
while Bank of America has a broader retail and consumer focus,
often supporting government-linked programs like mortgage support or small business lending. That's why the valuation and profitability of private banks can vary, depending on their strategy, risk exposure, and investment decisions. The profit from the difference between interest earned and interest paid is known as net interest income, NII. If you divide that by the total assets or loans, you get the net interest margin, NIM, a key indicator of a bank's profitability. Let's look at the NIM of our two examples. In Q3 of FY 2021, JPMorgan Chase had a 2.33% NIM,
while Bank of America had 2.01%, so JPMorgan is slightly more profitable in this regard. Another key metric is the non-performing loan, NPL ratio, the percentage of loans unlikely to be repaid. For JPMorgan,
this was 0.67%, and for Bank of America,
0.79%, both healthy levels. Generally, if this figure rises above 5 to 6%,
it becomes worrisome for the bank's stability. Now, let's compare profitability. So JPMorgan Chase's annual revenue,
interest expenses, and operational costs lead to what's called financing profit. In March 2021, it was around $5 billion before accounting for other income sources. After adding trading revenue and investments and subtracting depreciation, the profit before tax reached $48 billion.
After taxes, net profit stood at $39 billion. Bank of America's figures were similar. Its net profit in 2021 was around $32 billion. So while JPMorgan leads slightly, both operate on the same strong model. This doesn't mean JPMorgan is better. Bank of America has its own strengths, such as a broad retail focus and stability. I showed you this comparison simply to explain their business models. So, friends, this is how the banking business works in the US. And if you ever wish to start a bank, you can.
Because starting a private bank is a form of business. You just need $5 billion in initial capital.
According to estimates, plus permission from the Federal Reserve, the
banking regulator. So if you happen to have $5 billion lying around, give it a try.
And let me know in the comments which business model you'd like explained next.